Good afternoon, everyone. In today's video, there's really one key thing that I'd like to share, and that's the trend line inside of the S&P 500 that I'm monitoring to try and see if this relief rally that we've had since May 20th is officially over. Now, in today's video, there's three key things that I'll be talking about. The first is breaking down this trend line in a little bit more detail. We've had a nice, strong, bullish uptrend since May 20th. It's been respecting one key trend line, and that's been very indicative of a bear market relief rally. This came on the backs of 7 consecutive weeks of bearish activity. We broke this down in a video where we saw that historically this doesn't happen very often, and we expected a relief rally to take place. Well, now we've gotten that relief rally, and to me, we're in a key important decision zone. Do we break this trend line, that's at least decision 1, and resume the bearish trend that we had? Or B, do we continue trending higher, meaning that this bear market relief rally continues at least into summer, or at least for a few more weeks, whatever it is. So those are the two decisions, and I'll show you what I think the sign will be for this potential break. There's a key candle structure that I'm looking out for. Now, outside of that, we'll also touch on the volatility we saw inside of the major index markets. This will include the S&P, the Dow, the Nasdaq, and the Russell. And more importantly, how did that volatility reaction take place to this trend line that we have from May 20th? That trend line is very much getting touched now, so that's why I think it's at this decision point. Either it's going to break, or we're just going to keep respecting it and bouncing pretty dramatically from there. So let's take a look at charts. We'll start with the S&P 500 and this trend line, and then make our way to the 4 other index markets. Now, inside of the S&P here, I'm on a daily time frame chart, and if I zoom in, this is May 20th's candle right here. And ever since May 20th, price action has just been climbing higher and higher, now pulling back to the market pulse line. This right here is setting up what we would have as our trend following setup. If you haven't already seen that video, there's this video that I'll link in the description box, which breaks down this setup in a bit more detail. The overall idea is we have a bearish trend, price pulled back to the market pulse line, that's our pullback level, and we want to see this trend resume. So that's setup 1, which already supports this idea. Now, if we take a look at this trend line, we can see the candle with today's after hours activity is officially opening outside of this trend line. Now, if we have a weak candle, something with just wicks, then that calls for us to just redraw this trend line and fix it. However, if we have a pretty clean, decisive break here, something that looks like this red candle, very clean, decisive, bearish break, then to me, that would be the resumption of this bearish trend, and this trend line is officially broken. This relief rally, at least in my eyes, is over, and I'd be looking to play short with the stop above this level, above 4,200, and our downside target is near that 1272, 3730 for our stretch zone. So that's the S&P 500. If you take a look at some other markets as well, so let's look at, say, QQQ here. You'll notice a similar trend line, along with we've had this downward channel inside of the Qs. Even if you pick a random stock, let's choose something like, say, Lowe's. Even inside of Lowe's, you'll see a similar idea. Pull back to the market pulse, really on the backs of this uptrend since May 20th, and we're now looking to see what happens here. So I think it's a pivotal point for the broader markets, for most major stocks, and I think this is going to be the telltale sign, what happens with this trend line. Now, if I come into that 1-minute time frame chart, let's see what the volatility looks like as we wait for price to break one way or the other. First thing to call out is price respecting this trend line for intraday bounces. You can see that here, 1, 2, 3, just today in itself. Each time we fell into that trend line, we bounced, smaller bounce, double top, or double bottom, and then another bounce into the close. So that's bounces off of the trend line, but it's a little harder in my opinion to take advantage of these from an actual setup. That's where the volatility came into play, and if we take a look using our volatility box, this is on the futures markets, and using the futures hourly models, the scalper model loaded on, which is our most aggressive model that we had for this muted volatility we're seeing. The S&P fell inside of our volatility box zones, the scalper zones, that's step 1. We had the edge signal, that's step 2, and that's the setup rules now being met. Our risk is from the cyan line to the outer edge of the clouds, which was 8 points, and we were looking for that same 8 points in the opposite direction, which we got with this flush move up. So that's the setup inside of the S&P, which hit just the first target. Similarly, inside of the Dow Jones market, we had the same setup, which hit a target inside of the Dow as well. In the Dow, the risk was 53, 55 points, and we hit that same mark going up to, I think, about 56, 58 points, depending on your entry. In both of these markets, you had better entries in the cyan line. Now inside of the NASDAQ, price went outside of our clouds before we saw this edge signal. So that took us from the scalper into the aggressive, and if I load in the aggressive volatility box, and by the time we hit the cyan lines, we bounced up from there, not really having an opportunity to play this move. And then finally, inside of the Russell, back to the scalper, the Russell was very much just a chop fest. We had our move into the volatility box and then really just chopped around sideways all day. So the S&P and the Dow, to me, were the two markets with interesting opportunities where we had some nice volatility breaches. We also had trend line bounces that were respected, pretty systematic. And now, in terms of our daily chart, we have that trend line that we're monitoring for in terms of, do we break and see this bearish trend resume, or do we continue charging up higher and seeing us slam into either previous resistance from these highs, even though we're already at really previous resistance from this previous support zone right now, which is acting as resistance. So a lot of different perspectives, but hopefully helps share what I'm looking at and the different signs to help prove which quote-unquote scenario is in play. Hope this video was helpful. Take care, everyone. Good luck trading. Again, for all Volatility Box members, keep a lookout for our new tutorial that will be coming out this week, which is that opening range breakout backtester. All right, take care, good luck trading, and we'll see you in the next update.